Here's why joint brokerage accounts are a mistake from an estate planning perspective. For one thing, there's no step up in basis. A joint account holder acquires the basis of the deceased joint tenant. There's no step up at death like other assets get. And so you're missing out on a capital gains savings of 15 to 20% of one half of the brokerage account's value by having it titled as a joint brokerage account. Secondly, the surviving spouse does not obtain creditor protections. If you were to send your half of the brokerage account through your living trust, the trust becomes irrevocable when you pass away, and the new trustee and the new beneficiary in most spousal situations would be your spouse, and so they get creditor protections because of the irrevocable nature of the trust. This can be a really big deal for Medicaid, especially. And in a Medicaid scenario, the government becomes your creditor. You have to repay the government for any healthcare expenses incurred during your lifetime at death in certain scenarios. And in a Medicaid scenario, the irrevocable trust asset for the spouse would protect the surviving spouse from having to do a Medicaid spend down on those assets.